Good morning, everybody. Thank you for taking some time out of the day to come to this webinar. My name is Dave Vitullo. I'm the head marketer here at EverVest. We are very fortunate enough to also have Brent DeGroot from OneAmerica on the webinar with us. He's going to be going over quite a bit about OneAmerica as well as another option, kind of building off our last webinar. So, Brent.
Run with it from here, Dave. Is that good?
I'm good.
All right. Well, thank you, Dave. I appreciate the invite. Thank you, everybody, for coming out today. And yeah, some pretty exciting stuff. I know last week. Last time we focused more on our life chassis, but today I'm going to really be talking to you about a very simple yet very effective way to use our annuity platform to create really low-hanging fruit opportunities for just by using your existing block of clients that you have. So, and really what we're going to be talking about is doing a 1035 exchange and utilizing the Pension Protection Act. So, you know, the Pension Protection Act's been around now for over 15 years. It's amazing to me that most consumers have no idea what the Pension Protection Act is. And many advisors really either don't know or have forgotten what the Pension Protection Act does, especially for us here in long-term care planning. So more about that in just a minute, but I'm really going to create a what I feel is a very simple and low-hanging fruit opportunity for you by using these adaptable annuities. Yes, that's the way we're going to afford it. Okay, so first and foremost, I want to talk a little bit about OneAmerica and who we are. We've been around in the long-term care planning space now for 37 years. I know that says 35, but actually our first policy was sold in 1988, the year I graduated from high school. So I can't, but so we can trace our roots back 37 years in the asset-based long-term care planning space. We are one of the first to market, and so we are a leader in this this area. Now, the companies of OneAmerica, which are a number, that's more or less an umbrella company, we can trace our roots all the way back to 1877 as an insurance company. So again, long-standing history here. We've got all the financial ratings that you can see there, especially when it comes to talking to your clients about any insurance product. You want to make sure that those ratings are high. So 95 Comdex, A+ rated from AM Best, and AA- from S&P. Flexibility, I talked about. We've got two options here, our life-based chassis and our annuity-based chassis, but really going to be focusing on our annuity-based chassis today. And then we've got lots of regionals around the country, myself included. I actually happen to reside in Omaha, Nebraska. It's right in the middle of the country. And certainly happy to introduce you to some of our other regionals that are around the country as well, if you would ever need access to them. For that, I would ask that you go out to EverVest, talk to Dave or any of the other marketers there at EverVest, and we can put you in touch with them if needed. They're just there for extra support, point of sale help, things of that nature. And then one of the things that I'm really excited about is our care benefit concierge. So for every claimant that we have, so every policyholder and every claimant that is there, we assign a single point care benefit concierge. And we get a ton of great feedback about these folks. They're in Indianapolis, where we are located, where our home office is. So we haven't, shipped our claims across the ocean somewhere. So no language barriers, time zones, that sort of thing. We really get a lot of great feedback about it. And there's no, calling in multiple times, re-explaining the situation. We've got a single person concierge for each of those claims that are there. So again, our customers, your clients, certainly like that aspect. All right, so ponder this. Now, when I say long-term care, for those of you who are on the call today, many times there's maybe a negative connotation that comes up with that. And, so I always say, what's the first thing you think of when I say long-term care? But it's really not what we should be thinking about. Planning is in your DNA, and many of the clients that you're working with, obviously, they're planners as well. So that's why they work with you to make sure that they've got an extended care plan in place. So get rid of that long-term care language. Add this language into any planning that you're doing with your clients. It's extended care planning to get rid of some of those negative connotations. All right, a rhetorical question here, but who's heard of the silver tsunami? And really what this is really the aging of Americans today. So as the American population ages, they are really calling this the silver tsunami, largely because with aging, there comes aspects of needing care. And if you look at this nice little picture here, it's a little blurry, I apologize. That's a big wave tsunami coming in. And you can see at the bottom, well, it's kind of the middle of the slide here, but the bottom of that picture, bottom left-hand side, there's some people there that are, they're going to be in serious trouble when that wave hits. Not only are these, buildings and so forth going to get wiped out by that tsunami, but really the reason they're calling it the silver tsunami is because we understand with the aging of Americans today that there's going to be a healthcare crisis for those needing care. So if you haven't heard that term silver tsunami, it's maybe one that you want to put in your lexicon, if you will. And largely it all has to do with the baby boomer impact. And what am I talking about? Well, back in 2000, the annual LTC expenses were around $30 billion. The first baby boomer turned 65 in 2011. And many of you may have heard those stats that as of January 1st of 2011, there were 10,000 baby boomers turning 65 each day thereafter. So by 2015, the expenses had grown from 30,000 to 30 billion to 225 billion. And so that's a 750% increase. So knowing that in 2019, we're seeing increases there as well, I do want to talk about this. January 1st of 2026, so just a short period away, a few months away here, the first baby boomer will turn 80. And again, now we're going to be talking those that are still living out of those 10,000 that turned 65 in 2011, they're all going to be turning 80 every day. So why is that so vitally important to know? Because the LTC industry in and of themselves say that claims start at age 80 or between 80 and 85. So knowing that we've got this baby boomer impact coming, that's where this whole term of silver tsunami comes into play. All right, so if a long-term care event comes into play, most of your clients, most of consumers, believe that they have plenty of assets. But remember, this is not an asset problem. It's rarely thought that long-term care is a one-time event. It's not just a one-time payment. It's an ongoing monthly bill without an end date. Americans plan so much. We borrow credit and so forth, and we kind of plan in our budgeting for, I can afford that in my monthly budget. But this is an ongoing monthly bill with no exact end date in mind. So they'll need additional income to fill this gap. So the biggest thing here that I need to impart that long-term care is an income problem. It's not an asset problem. So again, when you hear that pushback of, I've got plenty of assets, that's not really what we need here today. We need the income to fill the gap from any of these expenditures. So speaking of that, I think this 4-bucket scenario really does a good job of kind of explaining some of this. So if income for long-term care is needed, and we've got $1 of an expense, you can see that up there in the silver bucket, $1 of LTC expenses, where do we want that income to come from? Do we want it from our IRAs, our qualified sources? You know, conservatively, that's a $1.30 for every dollar that you're going to have in expenses. Probably not the best bucket, right? That makes the most financial sense. How about your non-qualified dollars with capital gains there? Now you're paying $1.15 for every dollar. Again, maybe not the right source. Okay, then there's the red bucket, the cash bucket. Probably minimal taxes, if any, but is that still the most effective? Now we're just paying one for one, or trading dollars, if you will. Then we've got the most efficient and effective use by insuring that risk. And again, this could be 25 cents, it could be 33 cents, what some aspect in there, but it's much better to pay that amount of money for a dollar of expenditure for long-term care than, you know, any one of the other three buckets. But I would really say, you know, a dollar for dollar, or this yellow bucket there, is certainly the one that makes the most sense. I mentioned the silver tsunami early on, and I showed you those people that were going to get wiped out. And largely, this is what's going to happen to most individuals that don't have a plan. But I like to put a little levity in this presentation as well. And I want to show you the retired seniors here that did plan for this silver tsunami and see how they're really treating this. So it looks like it's a lot of fun to them. They're just riding that wave all the way to and through retirement. Hopefully you found some amusement in some of that. All right. That's great. Thanks, Dave. There's really two phases of annuities, and I told you really we're going to be talking about annuities today with this chapter. So you've got two phases, right? Accumulation and growth, right? That's one phase of it. And then there's the payout and distribution of those annuities. So much like building a retirement plan where it's accumulation and then you know, the end up paying out of that retirement portfolio, annuities kind of have the same type of aspect. So I wanted to give you some facts and figures around annuities as well. I mean, this annuity market is huge, and I know you're working with EverVest on many types of annuity opportunities, most of you, but you'll be not really surprised by this, but over $2.4 trillion are in retirement annuity assets. So a huge market. And as a matter of fact, last year in total sales, $434 billion in annuity sales just last year. So we know this is a huge market, and many of your clients that you're working with are buying them today. And many of you that have clients that have been in your portfolio for quite a number of years have had these in their portfolio for many years as well. So why did your client buy that annuity, right? So Gallup has done a poll, and they do it about every other year. And some interesting numbers that came out of here. We asked these non-qualified annuity owners why they purchased an annuity. Well, 84% of them said they used it as a financial cushion if they or their spouse lived beyond their life expectancy. So that was one of the reasons that they purchased. Another very high marks here, 79% said they wanted to avoid being a financial burden to their children. And another high factor here, over 2/3, said that they want to use it as an emergency fund for catastrophic illness or nursing home care. Really, all three of those reasons, those high percentage reasons of why they purchased an annuity, really focus on extended care planning or really a long-term care event. So knowing that that's a big reason why they purchase these annuities, really, how do they want to access those annuities? Well, enter the Pension Protection Act, written way back in 2006, but actually put into law on January 1st of 2010. But really what the Pension Protection Act did, for the most part, was focus on pension reform. And that's not really what we're talking about here. That was great. We needed to do some pension reform way back at the time. But when this went into play, there was a certain subsection, Section 844 of this act, that dealt specifically with annuities and long-term care and new tax treatments for that. So again, a 15-year plus old act that has been out here that really affords some great taxation favoritism for your clients who already have these non-qualified annuities that you work with today. So why is the PPA important? Well, really, we're shedding any income taxes that would be paid on any distribution from those non-qualified annuities. So here we're going to see that there is a annuity without Pension Protection Act benefits, if you will. So we've got obviously the cost basis, what they paid for it with after-tax dollars they put in, but then you've got the growth, right? And all of that growth is tax deferred. So when they go to take money out of that non-qualified annuity, all of that gain portion is going to be taxed, and it's going to be taxed in many ways: federal, state, provisional income, Medicare premiums, IRMA. You may have heard of that term. Seniors are very concerned about their IRMA today. So if you're not, I would certainly suggest that you go out and look that term up, but it has to do with their Medicare premiums and how much taxes they'll be paying for that. So by simply doing a 1035 exchange of an existing non-qualified annuity into what is called a PPA annuity or Pension Protection Act annuity, then as long as they use those benefits for any long-term care services, all of those tax implications from not being a Pension Protection Act annuity will be shed. So it's all tax-free if used for long-term care. So can really show where, you know, a dollar is not going to be a dollar if it doesn't have the Pension Protection Act affordability, if you will. But if we just simply do a 1035 exchange, very simple process, can be done via our e-app. We've got 4 knockout questions, which I'm going to talk about here in just a minute. Once we exchange that, now once the consumer, your client, accesses that money, it'll all be tax-free if used for long-term care. I'll talk about what happens if they don't use it for long-term care in just a minute here, but some other things that I really want to talk to you about. You know, looking at the tax favoritism here by just simply moving it to a Pension Protection Act, what happens is many times these annuities are singly owned. And to do a 1035 exchange, we know we have to follow those like-for-like rules. So knowing that there's this tax favoritism by just moving it to a Pension Protection Act annuity, lots of times we find that those annuities are singly owned. But we've got something which we call an eligible person provision. And that says, look, once the client understands that just by moving it here, I've got a lot of extra tax favoritism, extra taxes that I won't have to pay if I use it for long-term care. That's one of the main reasons that I put this annuity in place in the first place. Well, many times they want to maximize that. And we can do something which is called the eligible person provision, so that we can add that spouse through the application process to that annuity and let them have joint access to that same annuity, thus doubling, if you will, or multiplying at least the benefits, the tax-free nature of the monies out of that non-qualified annuity. Now, if it was a jointly owned annuity, we still 1035 exchange it, and it's still just jointly owned. But this eligible person provision really maximizes those tax savings that are out there. And again, once the customer understands this, of course they want to add their spouse if they have one. And I see there was a question. We'll get to that here at the end. I don't think we hit that up front. So bear with me just a moment. We will get to your question. So I get this question a lot when I'm out doing this in front of advisors live. So I like to incorporate that into some of my slides. Well, let's compare the annuities. What is my client giving up by exchanging this to a Pension Protection Act annuity? Well, let's look at that. Here's that existing annuity kind of in the middle column there. So you've got your tax deferred growth, account value access, you know, those 10% free withdrawals, all that's there. Well, if you look to the Pension Protection Act annuity on the last column, we've got all those areas covered as well. What if they never need it for long-term care? Well, okay, so here we've got the ability to pass that along. There will be some taxation that if they don't need it for long-term care purposes and there's still some money left over, yes, it will be passed to their beneficiaries, but there will still be some income tax on that. Of course, by moving it to the Pension Protection Act annuity, same thing is afforded there as well. But what we're missing out on, you're actually not losing, you're actually gaining some options by moving it to a Pension Protection Act. You get the tax-free income for long-term care. Again, we can add that spouse, maximizing those tax-free income for long-term care. And then every one of our policies come with our claims concierge program, which I hit a little bit on the outset of this presentation as well. So not losing anything, actually gaining more benefits by moving. Now, if you're in the annuity space, and that's really what you work on, nobody likes underwriting. I will say that up front. No matter what kind of insurance product it is, most of the time we're going to have some sort of annuity. And in order to be a Pension Protection Act annuity, the federal government said they must have some form of underwriting to them. So very simply, what we're going to ask is 4 knockout questions. We'll actually ask 5, but it doesn't really matter on that last question if they answer yes or no. We're not going to use that for underwriting purposes. So if you do this whole process with your clients through our e-app, you're going to be asked these 5 questions. As long as they can answer no to the first 4, they will be instantly approved. So it's a very, very simple process. And quite honestly, if you look at these, and I won't read them all completely, but I will say they're pretty straightforward. The first 3 questions are they receiving care today? So here's your first question. Do they currently use any mechanical devices, a wheelchair, walker, dialysis, quad cane, motorized scooter? So pretty simple to know right up front. As a matter of fact, you can show these to your client up front as well. So you can know whether you want to even submit an application. So there'll be no underwriting surprises. You'll know up front that they can answer no to all these questions. Second one there is, do you need any help with your activities of daily living? And you can read what those are. Obviously, that's a trigger for a long-term care policy. So that must be answered no. The third one is, do they have any of the major conditions? Alzheimer's, dementia, Lou Gehrig's disease, Parkinson's, multiple sclerosis. So some of the biggie conditions, right? And again, if they can answer no to those first 3 questions, we move on to the 4th. Have they ever been diagnosed with AIDS or AIDS-related disorders? So very simple for most clients to qualify here. So, that doesn't mean, it doesn't mention cancer. It doesn't mention anxieties, any of those kind of things. So while many people have some of those aspects, that's not a knockout question. If they can answer no to these 4 knockout questions, we do a simple 1035 exchange and it's instantly approved. So let's talk about the annuity exchange and the ability here. So I like to just look at the concept of a deferred annuity with these LTC benefits. Here's a very well-balanced portfolio, right? And essentially all we're doing is typically peeling away from the conservative aspect that's there to kind of maintain or preserve capital. And we'll just peel away, create an asset for them, and really leverage that for care. Now, in this base PPA exchange annuity program, really remember the leverage is coming from that tax-free nature if used for long-term care. So that's all past interest growth and any future growth as well. So these will continue to grow. They're afforded interest rates also. But all of that growth will be income tax free as long as they use it for long-term care. So pretty simple concept there. And I wanted to give you some quick case studies around this before we wrap it up and ask for some questions here. So I wanted to show you really a 77-year-old female, hypothetical example here, but we've got really 2 solutions that we can use for this base annuity exchange, if you will. And first and foremost, I'm going to use our annuity care. This is our original option that we rolled out in 1998. So long time we've had this plan available. And I want to just kind of show you what happens here. So here's a 77-year-old female. She had an existing non-qualified annuity worth $200,000. What we're showing here on the left-hand side is, yes, year one, what was available to her, but then years, after year 10 of growth, what's still afforded to her. So you can see that year one, we just do an exchange there of the $200,000. That affords her right off the bat of over $6,000 per month in a long-term care benefit. You can see that we grow that the actual account value and the LTC value, and we've grown that to over $7,000 and $8,000 in the total value. But now let's look at year 10, what that has grown to. So her monthly benefit originally in year one was $6,050, if you will. But now we've got a monthly benefit of nearly $8,900 as a monthly benefit for her to use out of that original annuity. The account value has grown from $200,000 now to nearly $292,000. And then the total LTC value that she would get out of that is over $306,000. So pretty straightforward here. What I'm going to show you a little bit of difference. This original annuity care takes that amount and pays it out over a 36-month period. That's kind of, it's really a calculation that we use, and that's where we get that monthly benefit amount from. So we just take what the total LTC value is divided by 36 here, and that's what gives that monthly LTC benefit amount. Now, the one that I'm recommending probably more than that, even though that 3-year plan is a great average plan of care, we're seeing more people want to go for kind of an indexed annuity. So they want to take advantage of the market gains, but none of the downside risk here. So same 77-year-old female, but we're putting it into our indexed annuity care base annuity. And so I want to show you kind of the differences here between those. Now, the biggest difference is the indexed annuity pays out over a 24-month period. So again, we take that, whatever the total LTC account value is, and we spread that out over 24 months. So naturally, you're going to see a higher amount because we're paying that out quicker in the indexed annuity care solution. So 200,000 came over. You can see here we've got nearly $8,900 as a monthly benefit, but you can see that after year one of growth, it grew from 200,000 to over 210, and the total LTC value was over 212. But look at year 10. Now the monthly benefit has grown to almost $16,500 per month that she has as a LTC benefit. But look what the account value and total account value has done. The account value or the death benefit, if she would never use it, has grown to nearly 360, and then the total LTC value for her has grown to nearly 400,000. So great way. Plus, this particular solution has a guaranteed step up, kind of acts like inflation. So I really am recommending the indexed annuity care in most of these situations, but I just wanted to really show you exactly what's available for that. Now, very quickly, I talked about this at the outset, but our care benefit concierge is just one phone call away. And what that really allows the family to do, that person that needs care, right? It allows them to love on their individual, really, and let our care benefit concierge really help them through the whole process. So it really starts with them just initiating that claim, and then we'll do all these dedicated services with the family. And again, let them focus on their loved one and adapting into the new situation that has come. So very briefly, to wrap this all up as really a call to action, I want you to look at your own book of business. Very simply, look for those with non-qualified annuities that have been in your portfolio for quite a number of years. But if they're aged 75 to 87, that's kind of where I want you to focus. That's perfect for these types of solutions. Consider this as one last roll for that non-qualified annuity. Many times you're working with them and you're, putting them into an annuity. You wait till that surrender charge passes, and then you move them to the next annuity that has the next highest interest rate. Well, this is kind of one last turn once they get to those advanced ages, right? So from 75 to age 87, look at your current book of business and say, hey, here's low-hanging fruit, because now we can add the do a joint coverage type situation. They get the care benefit concierge. We got instant approval if they can answer no to those 4 questions, all the way up to $1 million. So I've seen a few of these even come in that have been over $1 million that we've allowed. Now I do need an exception process for that, and then they're fully commissionable up to age 85, 86 and 87, a slight commission reduction. But this is a great way to make one last turn for those clients that are already in your book of business. So again, 75 to age 87. Now, I focused on our base annuity only today because I think it's a huge opportunity for all of you. But you want more leverage? Well, then I'm going to ask you to come back on the 24th and we'll get into the annuity side with leverage outside of the Pension Protection Act tax-free nature, more on the 24th. So with that, here's a resource page. I'll leave this up and just start asking any questions because I know there was at least one of them out there.
There's a couple questions there, Brent. We're also going to put up a poll or a couple quick questions here as well. Take 5, 10, 15 seconds to just answer that. We'll get you right back to the screen. But we do have quite a few, questions here, so we could tackle those, Brent. We've got first one. Does this work with IRA accounts for the base annuity?
Yeah, so great question. This is non-qualified annuity, so it would be with after-tax dollars, right? So we do have options in more of our leveraged scenarios. I typically will say with an IRA type of annuity or something like that, or a qualified source, we've got other options either on our life chassis. But there's some taxation that happens with the annuities with using qualified, and many consumers, have understood that LTC benefits are all tax-free. So when we're using qualified funds, to know that they're still going to be taxed, because of course the government's going to get their money some way, somehow on any qualified source. That's just something we need to explain up front. So we can use them, but it can't be used in this tax-free nature utilizing the Pension Protection Act. One of the rules of the Pension Protection Act was it must be a non-qualified annuity, not qualified accounts. So great question.
We've got another one about underwriting questions for the base annuity. Are those the only underwriting questions we have to qualify?
That is it. Yeah, and what I like about these underwriting questions, again, we're going to ask that 5th one. It doesn't matter if they answer yes or no, but really we're just doing 4 knockout questions for this base annuity exchange. So show them to your client up front or talk to them about it, because that way okay, is this a client that is worth doing this with? You'll know up front. As long as they can say no, there'll be no underwriting surprises, and nobody likes underwriting surprises. So that's it.
Love
Nothing
it.
behind.
Another quick question. Commissions on the base annuity, what does that pay up to 85?
Yep, and I'm going to let EverVest work with you on the commission aspect of that. I mean, that is, we do, yes, we all want to get paid, right? We do pay commission on these. So I will let you have that discussion with your EverVest marketer there.
This next question I can answer involving securities license. You do not need a securities license to sell an indexed annuity, but with the LTC, what, I guess, designations do you need, or what extra training do you need to sell that base product, Brett?
Yeah, good question there, Dave. You will need your partnership training. Any type of LTC type of solution, you need that partnership training, and so that's if you've never done it, it's an initial 8-hour class, and then you've got a 4-hour refresher every 2 years. So you will need a health license or a health and life license, depending on what your state, how they allocate those, and then you'll need that LTC partnership training, and then we've got a very simple annuity training that would be required as well.
Got it. Perfect. Thank you. This next question is asking, how do you designate the Pension Protection Act on the annuity form, I guess?
Yeah, so, yep, a good question as well. All of our annuities here at OneAmerica are Pension Protection Act annuities, so they're already designated. So there's no, you don't have to, there's no extra check marks or no, like a cover sheet or something like that. They are all Pension Protection Act eligible annuities. And that's why we've got the underwriting that we do.
Perfect. I can answer this one. Do you offer the life insurance with LTC benefits? Yes, that was covered in the first webinar we did. That is with their asset care funding with whole life insurance. I can definitely get you that recording as well, or reach out to someone here and we can answer those for you. And then the replay, yes, we can get a replay out as well. So I think we'll wrap up here, Brent. We went a little over. I appreciate everyone's time. We will be having one more webinar here in 2 weeks. Like Brent mentioned, we are going to be going over more in depth on the annuity care, indexed annuity care, trying to show you guys how to get a little more leverage than this, how Brent put it, low-hanging fruit solution with OneAmerica. So we encourage everyone to attend that one. It will be the final, but we will also hopefully see you guys there. So.
Well, wonderful, Dave. Thank you. Thank you, everybody, for coming out today. Yes, we will talk about more leverage on the 24th. So hope to see you all back.
Awesome. Thank you, guys.
Bye now.
And thank you, Brent.
Thank you.